Are you searching for information about what to do with your 401k plan because you're leaving your current employer? Maybe you're retiring. Maybe you got a new job. Well, you're in the right place. I'm Amy Buck. I'm owner of Plan Path Financial, and you found me on my YouTube channel, Retirement Planning 411. So there are basically four choices that you have, but one of them we're going to take off the table right now, and that is taking a full distribution of your plan. Now, the 401k plan might require that you take a full distribution if you have just a small amount in that fund or in that plan. Otherwise, it's just a bad idea because you're going to have to pay tax on that entire distribution and pay fees on top of that if you're not 59 and a half. So typically not the best choice. So let's move on from that and talk about the three choices you have that you may want to consider. The first one we'll talk about is rolling your 401k plan over into an IRA. And this is probably what we see done most often, but it's not always the best option. So make sure you listen to all of these things before you make your final decision. So rolling your 401k into an IRA really just simplifies things, especially for those of you who have, like a lot of my clients do when they come to me, 3, 4, or 5 different 401k plans floating around out there. That means you have several different statements each month. You have for each quarter whenever you get them. You have all those different investment options you have to keep track of, passwords to get onto the online accounts. It's just messy. It's overwhelming. Where you can move it all into one account and simplify things. Second is investment options. 401k plans typically don't have very many investment options available to participants. You may see 10, 15 different choices. And when you're trying to put together a nice diversified portfolio, you might not have choices that you would have wanted to make. An IRA, on the other hand, according to the IRS, you can hold any investment in your IRA other than commodities and insurance. So pretty wide open field there. Now, custodians like Fidelity, Schwab, Vanguard, etc., they may limit you to stocks, bonds, mutual funds, um, ETFs, electronic traded funds. But some custodians even allow you to get into alternative investments like REITs, hedge funds, etc., but just thousands more investment options than the 10 or 15 that you get in a 401k plan. So that allows us to accomplish the third reason, and that is lower fees. Typically, a 401k plan is going to utilize mutual funds as investment options in that plan. Not always, but typically. Mutual funds typically have higher fees than things like ETFs, electronic traded funds. But you can find electronic traded funds to accomplish the same goal as you would with a mutual fund. The fees are just lower. So having more investment options allows you to shop for better prices on your investments as well while you're putting a portfolio together. That leads us to the third or the fourth reason, I guess, we are on, and that is more flexibility. Now, these next few reasons have more to do with when you actually start taking distributions out of your accounts in retirement. So when I talk about flexibility, I'm talking about how often you can take withdrawals from your funds. So when a 401k plan, oftentimes they're going to limit the number of distributions you can take out of that plan in any given quarter or year. And if you go beyond that, you may end up paying a fee. With a IRA, you could take as many distributions as you want throughout the year. So you can really just tailor those distributions to what your cash flow needs are on your time. You're in more control of that. Which leads us to the second reason why or I shouldn't say second, this is like the fourth, fifth one, but second reason why during retirement and distribution time, the IRA may make more sense. And that has to do with required minimum distributions. RMDs. You've probably heard of that before. This is when the government says, okay, you've had this money that you put in pre-tax into your retirement account, into your 401k, growing tax deferred long enough. And now we want to start collecting tax on at least this minimum amount. They provide you with a tax table. And this is out of both IRAs and 401ks that you have to take RMDs. They provide you with a tax table. You use that table along with your age and the value of the account on December 31st of the previous year to come up with that number, what that required and minimum distribution is. Now, why an IRA may be a better choice when it comes to RMDs, or one of the reasons why, is that with 401ks, and especially if you're somebody that has all these different 401ks floating around out there, you have to calculate a different RMD for each plan. You have to sell positions out of each plan to satisfy that RMD and then make that withdrawal out of each separate plan. With an IRA, it just gets back to simplicity again, especially if you rolled them all over into just one IRA plan. You're calculating one RMD and taking one distribution. Now, you may have more than one IRA. There are reasons why people have more than one. If you do, let's say you have two, you would have to calculate a separate RMD for each one, but you can add those amounts together and take all of it from one or the other if you choose to do that. You could take it from each if you want, but you can also just take the total amount of one, as long as you're satisfying what that minimum is for both of them combined. All right, so RMDs leads us into another acronym called QCDs. And the way that those two things are tied together is that QCDs are qualified charitable distributions. They are a way, if you are charitably inclined, of taking tax-free distributions out of your IRA that go directly to the qualified charitable organization. And those donations to those organizations that come out of your IRA account can satisfy the required minimum distribution. So it can wipe out the tax that you would have to pay on those distributions that year. So let's think of an example. Let's say that your required minimum distribution out of your IRA in your first year that you have RMDs, your 73rd year, if it's 2024, is $3,000. And you are somebody who gives money to your church every week. You throw money into the collection plate. And over the year, that ends up costing $2,000, or you end up donating $2,000 to your church. If you take that as a distribution out of your IRA, have your custodian write a check to your church for the $2,000 and send that to them just one time that year. That is a tax-free distribution that comes out of your IRA, and it goes up against your RMD to satisfy $2,000 worth of that $3,000 required minimum distribution. So you'd only end up paying tax on the $1,000 that were left. So the answer is yes. If you want to donate $3,000 and that's what your RMD is, you could wipe out that tax liability altogether by making $3,000 worth of donations to a charitable organization with your IRA funds. But you're not limited to what your RMD amount is either. You can actually make up to $105,000 worth of charitable donations out of your IRA account, as long as it's going to qualified charitable organizations, and it's coming out of the IRA account. But whatever your RMD amount is, if you donate that much, you would have wiped out the tax consequence. So some people don't need the income out of their IRAs. All it ends up doing is giving them more tax burden for that year. So if you're charitably inclined, that can be a really slick way of accomplishing both tasks. Now, you're probably thinking at this point, but I could deduct those charitable donations anyway. So why go through all the work of taking the QCD out of the IRA and working with the custodian and doing all that? Why not just write the check out of my checking account, take the deduction at the end of the year? Boom. Well, that is true, but that only works, first of all, if you itemize, and you have to have enough donations and all the other things that you can itemize in order to do the itemization. But even if you do itemize, keep in mind that that deduction is only coming off of your taxable income. You would have still taken that distribution out of your IRA. That RMD amount is still going to affect your gross income amount. That has implications for how much your Medicare payments are and also how much net investment income tax you pay. So keep in mind, QCDs not only lower your taxable income, but they do not add to your gross income. Oh, and it's important to note that in order to do a QCD, you have to have had your 70 and a half birthday. So not in your 70th year, but you actually have to have passed the date when you turn 70.5 years old. All right, moving on. The last reason why you may choose to roll over into your IRA is having more control over the withholding from your distribution. With a 401k, anytime you take a distribution, you are automatically going to have 20% withheld for taxes in the 401k plan. So if you take a $10,000 distribution, you're going to get $8,000, but $2,000 is going to be withheld, which is all fine and dandy because you have to pay taxes anyway. But what if 20% isn't your number? What if you're only in the 11% effective tax rate? Or you are in the 35% tax rate and it wouldn't be enough taken out? With an IRA, you decide what the withholding is from each one of those distributions. So you're just in more control about when you're paying tax on your distributions through the year. All right, from here, we're going to move on to the next choice you have with your 401k, and that is just to leave it with the employer that you're leaving, if they allow that. And many plans do allow you to leave the funds back with them. So the first reason why you might choose to do that is that the plan that you had there had pretty good investment options, and they were actually really low cost. That does happen. It's not common that they're lower cost than your other options would be, but it could be that you have those low fee options with good investment choices, and you might as well just leave it there. Unless there's another good reason to move it into an IRA or into your new 401k plan. But with all of the things considered, there's nothing wrong with leaving it there if you're happy from a investment choice and fees standpoint. The next option, or the next reason why that option makes sense, is something called NUA. And this only pertains to people who have their employer's stock in their 401k plan. So if you have purchased or acquired company stock at that employer's, when you're with that employer, it's in that 401k plan, and if it also is highly appreciated, NUA may make sense for you. That is a special tax rule that allows you to save taxes on that stock when you move it into a brokerage account. So we are not going to get into the nitty gritty. I'm just going to give you kind of a high flyover of what this ends up looking like. But there are a lot more details to it that you would need to know if you're actually going to do this. So you would need to do more research. This is more of just a heads up that here's something else to think about. So if you in fact have a chunk of employer stock, let's say that when you acquired the stock or purchased it, the value was $10,000. So that's your cost basis. Now it's worth $100,000. So that $90,000 between the cost basis and what it's worth now, that is the NUA, the net unrealized appreciation. And there are special tax rules for NUA if all things line up just right. By moving your stock into a brokerage account, paying tax on the cost basis. So in this case, it was the $10,000. You'd pay regular income tax rates on that. But then now you had this stock over in this taxable brokerage account. And just like any other stock that's sitting there, as it continues to appreciate, and when you do finally sell, Instead of having unrealized gains within that account, now you will have realized gains that you pay capital gains tax rates on. So typically, when you are rolling over money out of your 401k, it has to go into an IRA account. But the IRS allows you with that employer stock, that highly appreciated employer stock, to move that into a brokerage account so long as you pay the tax on the cost basis. It gives you the tax benefit of capital gains on the sale of those shares instead of paying income tax that you would have paid on the distribution of that money out of your 401k or out of your IRA. So if you fall into that bucket of having that employer stock, take pause before you do anything with your 401k. Learn more about it, find out if it's the right thing for you to do. So if you're DIYer, there's more information out there that you can get. Or find a financial advisor. There are advisors out there who work on an hourly basis that could just help you with that piece of your puzzle if you're a DIYer and you just need help on that. But do your homework, make sure that you decide for sure if that applies to you prior to doing anything with the 401k, because once you roll it into an IRA or into another 401k, that opportunity is lost. And that could be a huge benefit if you have highly appreciated stock. You could save a lot of money. All right. Next, if you are going to keep your money in a 401k plan as opposed to an IRA, you might want to do that if you are somebody who is concerned about creditor protection. So both a 401k and an IRA plan offer bankruptcy protection. So if you had a bankruptcy and you have money in an IRA or in a 401k, those funds are protected from what's happening with your bankruptcy. They can't go after that money. But you only have creditor protection from a liability lawsuit in a 401k plan because of your recent rules that apply to a 401k. You do not have that with an IRA plan. So if you are somebody who's kind of at high risk for liability suits, maybe because of the business you have or whatnot, this is another reason to take pause and just decide, is that an important enough reason to leave it in the 401k plan? Or does the umbrella insurance that you have, cover you liability wise that you're not really concerned about that? But again, something to take pause on before you make that decision. Next is something called a mega backdoor Roth. And this applies really to high income earners. So I'm sure you've heard of a Roth IRA, money that you can take out tax-free at retirement because you've already paid tax on the amount that you contributed in. It's grown tax deferred, and now after age 59 and a half, and once you've satisfied a 5-year clock, again, we won't get into particulars of that, you now can take it out tax-free. However, high income earners, if they earn more than the threshold for contributions being allowed into a Roth IRA in any given year, they don't have that opportunity to get money into that tax-free bucket. So they look to two things. One is called a backdoor Roth, and that is done with an IRA to a Roth IRA conversion. So they put non-deductible funds into an IRA, convert it over into a Roth IRA, and there's special rules and clocks, the 5-year clock for that. We won't get into it. But there's also a mega backdoor Roth, which allows for a much bigger conversion to Roth IRA funds. But there's two things that have to be true about your 401k. Your employer has to allow after-tax contributions, and they have to have that 401k, that Roth 401k component, or allow in-service conversions over to an IRA, a Roth IRA. So check with your 401k if mega backdoor Roth is on your financial plan. That's something you want to do, and you've got money in that 401k with your employer. Take pause, get all that figured out, because if you want to be able to do a mega backdoor Roth after you've moved that money over into a new 401k plan, and again, that employer would have to allow those after-tax contributions, have the Roth component in their 401k. or if you've already started one in your current employer's plan, like you've already done one this year, you do not want to roll that money into a new plan or into an IRA in that same year because you could really mess up the tax consequences of all of that. So another reason, if mega backdoor is something you're thinking, oh, that has to do with me, take pause, get more information about it, get help from an advisor if you need it, and make sure that all that's taken care of before you do any rollovers in your current plan. Wait till the next year. Or if you want to be able to do that later, make sure that you are rolling it into the new plan. So that takes us to 3 more reasons why you might want to roll your 401k from this employer that you're leaving into a new employer's plan. The first one is if you continue working past your RMD age. So some people enjoy their job, they want to stay at it into their 70s, however old. Remember, 73 is that magic age in 2024. At that age, you have to start taking those minimum distributions. You are required to take them out of any 401k plans from your previous work or any pre-tax IRA plans. But with the 401k plan where you're currently working and you're already in RMD age, those RMDs are waived. So think about it this way. If you haven't moved all that money that you had from your previous employers into that 401k plan, you still have to take distributions out of those funds, whether it's in the old 401ks or in an IRA. But if you have moved that into the 401k plan where you continue working into RMD years, those are waived. They're only waived up until the point that you do end employment with that employer. And at that point, you'll end up taking a required minimum distribution out of your 401k and then rolling it over into IRA typically and taking distributions from there going forward. So again, reasons to plan ahead and really figure out how is it that I want my retirement to work? How do I want the cash flow to go? What do I want to pay taxes on? And where can I avoid paying taxes, etc. Last 2 is not if you're going to work late into retirement to RMDs, but if you're going to retire early. There's something called the rule of 55, where with the employer plan where you're currently working, if you decide that you want to retire early, and the earliest you can do that is age 55, and you want to be able to take penalty-free distributions from that 401k plan, up until you reach 59 and a half when you could do it penalty-free anyway. To bridge that gap between age 55 and 59 and a half, you can take distributions penalty-free out of that 401k where you last worked before you retired. Now, let's say that you were at your old employer. You're trying right now to figure out what to do with your 401k plan, and let's say you're age 53. But you know that you're planning to retire early from this next job. You're going to go work there for 2-3 more years, and then you want to be able to utilize funds from your 401k through that employer, so long as they allow all of this. But the rule of 55 says, even if you bring the money over from a previous employer, if they allow that rollover, you'll have those funds as well to work with to fund your retirement between that age 55 up until 59 and a half. Now, for those of you that are service workers like police officers, firefighters, air traffic control, you actually can do this at age 50. So I guess we could call it the rule of 50 instead of the rule of 55. When you reach age 50, you'll be able to take penalty-free withdrawals from your employer's plan at age 50 instead of age 55. Now, this isn't always the best option for funding your retirement. Your financial plan may have come up with ways that are much more tax efficient and allow for your cash flow in a way that saves you the most money and allows the most income in your retirement. But that is one option you want to consider before you make your decision about what to do with that 401k money. And then lastly, if you have plans to take a loan from your 401k funds, again, you've got this big chunk of money with your previous employer, you're going to a new one where you're not going to have a whole lot built up there just from that job alone. and in the next year or two, you were planning on taking a loan, let's say for a down payment on a house, it's going to be important to move those 401k funds into the new plan as long as that employer allows the rollover and they allow loans from the plan. Because if you know that's the only place you're going to be able to get that cash from for the down payment on the home or whatever it is, you want to make sure you have enough money there to do that. And one way is to get that 401k money from your previous employer rolled over into the new 401k plan. Again, might not be the best option for where to get money for that down payment or whatever it is that you need cash for. There's probably other things that you could do to plan ahead that are even better, but you want to make sure that you check the box and that is not something that you were going to be hoping you could do. And then you've ruined your chances of it because you either left the money back with your old employer where you no longer have the ability to take a loan, or you've rolled it into an IRA that doesn't allow loans to happen. So that's it in a nutshell. That's a lot of stuff. We didn't get into details about some of it, but you can find more information if you want to get into the nitty gritty about some of those topics on my channel, Retirement Planning 411. You'll be seeing more and more videos posted on Retirement Planning 411. So keep checking back there as you're looking for more information about your retirement. And thank you for joining me today.